Good morning, everyone. Thank you for your time today. We are Team M. My name is Liz. This is Jacob, Chris, Grace, and Joe. And our valuation of the Southern Company supports a buy recommendation with a 12-month target price of $75.58 and a 9.6 holding period return, so this includes capital appreciation as well as dividends. Now, the Southern Company has three main business segments. They have traditional electric utilities, natural gas utilities, and Southern Power, whose operations center around power generation assets with a focus on renewables. I also want to highlight that the Southern Company is the first company in the power utilities industry in the United States to build a nuclear power plant in the last 30 years. Now, we have three main assumptions that underpin our valuation today. So first is the Southern Company's constructive regulatory relationships. Second is its robust rate base expansion, and third is its healthy balance sheet. The Southern Company meets with the Public Utilities Commission every 2 to 3 years, and the Commission is responsible for controlling the company's authorized ROE, equity ratio, and cost recovery mechanisms. For example, subsidiary Alabama Power has access to a cost recovery called the Energy Cost Recovery, or ECR, which allows the firm to recover increases in energy costs without a formal rate case proceeding. Now I'm going to pass it to Jacob to expand on the firm's rate base.
So the second key driver underpinning our buy recommendation is the firm's robust rate-based expansion program. Now, as you'll see on the slide here, the firm is expected to invest over $48 billion through 2028, which reflects a $5 billion increase from what they expected at the end of the third quarter in 2023. And this is expected to drive 6% rate-based growth through that same period, and ultimately lead to a long-term EPS growth estimate of just over 5% according to our base case projections. Now, the only caveat to this is that the ability to fully realize this rate-based expansion and thus drive that earnings growth is really going to depend on the firm's liquidity position and the health of its balance sheet, which leads me into the discussion of our third key driver underpinning our buy recommendation, which is the firm's credit health. Now, the Southern Company maintains investment-grade credit ratings not only at the parent company, but each of the operating subsidiary levels, which have historically allowed the company to have pretty unrestricted access to the debt capital markets. Not only this, but the parent, in addition to its opcos, have maintained debt to capitalization ratios well below what they see in their loan covenants of 65 to 7% historically, and we expect that to continue well into the future. And finally, I'd like to touch on that at the end of the most recent fiscal year, the firm had over $7.6 billion in committed credit facilities and over $4.8 billion in total available liquidity. And so we feel very confident that not only will the firm be able to fund its planned rate-based expansion, but also fund its everyday working capital needs. Now moving into this discussion on some competitive positioning, one of the largest drivers or attractions driving investors towards the utility proves to be its dividend metrics. And if we look historically, the Southern Company has provided a dividend payout ratio that has consistently outpaced its industry peers on average of 1.2 times. And not only that, but that has led to a dividend yield that has also exceeded the S&P 500 in addition to the industry as a whole. So the Southern Company is doing a great job of solidifying its position as a strong dividend utility, offering strong growth into the future. Not only that, but a key metric to consider when looking at the value of the utility proves to be its operating cash flow coverage with regards to its capital expenditures. And even here, the Southern Company proves superior to its peers, with an operating cash flow coverage over its CapEx on average of 1.2 times that of the industry. And so with all of this being said, and this supporting our buy recommendation, I'm going to go ahead and pass it to Chris for some more explanation on the financial analysis.
So before we dive into the margins, it's really important to look into the historical trends and future projections for their input cost and revenues for the Southern Company. So as you can see here, in 2022, it's highlighted by the Russia launching their invasion of Ukraine. So the market uncertainty that was associated with that over the supply of fuel from Russia ultimately it drove an increase in fuel prices. So you see here that while it drove up, remember as we talked about earlier, the Southern Company operates on a cost recovery basis. So over the trend, even though as fuel prices went up slightly, you still see your revenues and prices grow pretty much hand in hand, line in line together, which results in similar margins, leading us into our consistent profitability graphic. You can see our gross margin 5-year CAGR. You see slight, steady, small, consistent, and reliable increases. Moving into operating margin, the Southern Company's operating margin is 1.2 times above their peers. So this operational efficiency drives value into the business. This leads us into our comparable firms analysis. So the Southern Company trades an EV to EBITDA multiple of 13.8 times, which is 12.2% above the industry median. In addition, their PE ratio trades at 25.7 times, which is 34.6% above the industry median. So we feel comfortable maintaining these elevated metrics in our valuation of comparable firms because of the competitive position that we talked about earlier with in regards to their dividends, their strong credit, and their strong cash flows. We feel comfortable using these elevated metrics in regards to valuation. So shifting gears a little bit, getting DCF analysis, we'll take a look at economic success in Georgia. So we'll look into where is this growth coming from in Georgia? So beginning in 2021, we see Georgia started to have a surge in their economic development and their revenues, and a lot of this came as a result of economic development projects, heightened capital spending, and favorable demographic trends. So this helped reassure our confidence in using Georgia as a key driver in our valuation and supported our 5-year 4.5% CAGR assumption for revenue for Georgia Power. So leading into, I'd like to discuss a little further the Integrated Resource Plan, or the IRP, for Georgia Power. They recently revised their projections. As you can see here, their peak demand is higher as a result of that. So this is also a positive sign signaling future success for the company. And with that, I'm going to turn it over to Grace for further valuation coverage.
Yeah, so let's transition into our DCF assumptions for the base case. So we utilized a weighted average cost of capital of 5.5%. We established an upside percentage of 7.2 and a weighted average price of $75.98. So this price was crafted using a 50-50 average of both a exit terminal multiple of 12.6 derived from an analysis of comparable firms, and an ending terminal growth rate of 2.8%, which is reflective of long-term market forecasts. So this, as I mentioned earlier, while the DCF constitutes the majority of our valuation, we also ran a supplementary single-stage DDM model to reinforce our DCF results. So we utilized a expected 2024 dividend of $2.86. We applied a terminal dividend growth rate of 2.9% and ended up yielding a target price just surpassing $83. So to tie it all together, we utilized a comprehensive approach, drawing upon several valuation methodologies to arrive at a weighted average price of $75.58. 80% of this valuation was driven in our DCF analysis, 10% in the DDM, and the remaining 10% in analysis of comparable firms. In addition, we ran a bear case analysis. The key drivers of this being a 20% reduction in rate-based growth, consequently reducing earnings growth, and also the possibility of Vogtle Unit 4 not reaching completion by the end of the first quarter. So with all this talk on valuation, I'm going to pass it on to Joe to discuss ESG.
Southern Company is dedicated to a smooth and effective transition of renewable energy and are at the forefront of industry-leading innovation. They're the 5th largest owner of renewable resources in the U.S., and Vogtle Units 3 and 4 are the first nuclear reactors built in the U.S. over the past 3 decades. They have set long-term goals for these sustainability efforts, specifically a 50% reduction in greenhouse gas emissions by 2030 and to be net zero by 2050. They are a leader in their disclosure and risk management efforts, as shown in the table below, and overall, they've shown a strong commitment toward this transition to a carbon-free economy. They also, through this transition, are focused on supporting its workforce and communities, as they've had 0 involuntary separations with employees since 2007 and have committed $225 million toward advancing equity and economic empowerment. They've also seen increases in their workforce for representation of women and people of color in their workforce and management over the past few years. And they've also shown strategic succession planning as they named Chris Womack the president and CEO of the company in March of 2023. He's been with the company since 1988 and was formerly the president and CEO of Georgia Power. He brings a lot of expertise and experience to the role. And they also prioritize regular board refreshment to bring in a variety of new perspectives. And lastly, the company is tied its long-term incentive awards with its greenhouse gas reduction performance, which emphasizes management's commitment to this renewable energy transition. And now I'll bring it back to Liz to close things out.
We are at time.
Thank you again, and we'd like to open the floor for any questions.
Can we dive a bit deeper into your bear case scenario? Like, what's the probability of the base case scenario happening, and how does that impact your evaluation?
Yeah, can you go back to the next one? The you can go up to the slide.
To evaluations.
Yeah. Sorry.
Anyway, so,
Want me to take it?
yeah, go ahead.
Yeah, so the thing with the bear case is we consider this an ultimate doomsday scenario. The key drivers, as we mentioned, behind the bear case were reduced capital expenditures, 25% reduction in that, regulators not being as cooperative with their investment goals, and ultimately them struggling to get the credit financing, the access to debt capital markets that they need. So we consider this a pretty probably unlikely that all of that comes together, especially given, as we discussed with Vogel, that the Southern Company is kind of a driver right now in sustainable energy. So with the political pressure on improving environmental causes, we believe that regulators will be continue to be very cooperative with the Southern Company to fund these sustainability plans, as talked about with the capital investments that they have planned. We think that regulators will continue to help out with this. And in addition, when it comes to being able to obtain debt, in February of 2023, they were able to issue 1.2 billion in debt. Their investment grade ratings for the parent and subsidiary are all investment grade. We feel confident that they're going to be able to continue to access debt as they're continuing to retire it. Circling it back together, with their strong access to debt and strong relationship with regulators, we believe that to be unlikely. We think the base case is a lot more likely, but we included that to show that the ultimate downside is still a lot, not as problematic. It's be under 10% decline versus the ultimate downside of another type of firm dropping would be a lot more substantial.
You looked at, in the case of market analysis, you said that the company's own multiple is actually trading at higher than the comparable company median, right?
Mm-hmm.
But in your DCF analysis, you considered using an exit multiple which was a median versus a higher level that the company is actually trading at. So do you expect that multiple to kind of, on a going forward basis, shift downwards, and what could be the reasons for that?
So I would say that the driving reason for utilizing that median multiple over, let's say, a max, was really because our base case assumptions in the revenue, I wouldn't say we were being necessarily not conservative or unconservative, but we were trying to display the growth in the key subsidiaries rather than having a ton of the valuation dependent on the exit multiple. And so we figured that using a median multiple would be a better, determination of the valuation. We also understand that at the valuation date, which was in January, it was trading at a significant premium, especially in terms of its earnings. I believe Chris mentioned it was like 32% of earnings, 22 and I think 25 times earnings. And so we think that in the future, our base case scenario assumes a 13.8 times EBITDA, right around a 22 times earnings. And so we think in the future that is sustainable. I do think it could go down, but I do think it will remain a premium to its peers. And the reason for that, touching on what we've sort of explained, it's a pioneer in the energy transition. Its regulatory backdrop is incredibly constructive. You look historically, their rate case decisions are very, very good. And we've seen that in 2023. We see it in their IRP that was updated. They can have additional procurement opportunities, rate-based expansion. And so we think that our valuation of that 13 times 8 EBITDA multiple on our base case will remain sustainable, although it could drop, but ultimately remaining at a premium to the industry peers.
In your presentation, you highlighted the dynamics of the state of Georgia. Why state of Georgia?
Well, the state of Georgia is kind of the biggest subsidiary that they have in Southern Company in general. And the revenues of the state of Georgia have grown substantially in the past few years, which really drives our assumptions of our revenue growth. So that was kind of the main reason for highlighting this important aspect of it.
Is the dynamics in the state of Georgia very different from other states where they operate?
I can tap in on that.
Yeah.
Yes, I think so. Their key service areas are obviously Georgia. They also have operations in Florida, Illinois, and Alabama. I apologize. And so Georgia is pretty unique in that they have recently seen pretty much a surge in their economic development. As we spoke about previously, I mean, the number of jobs available, the capital expenditures in aggregate are significantly higher. And not only that, I mean, I guess you could say Florida is experiencing something kind of similar, especially in population growth. But the reason we focus on Georgia, like Grace mentioned, is because one, the majority of their rate base growth that is driving the earnings of this firm is centered in Georgia. You look here, I mean, their revenue is, 39% of total consolidated 2023. And so like she was saying, that is the main driver. I mean, we modeled out each subsidiary individually, and that was sort of our growth opco.
Yeah, and I also want to add to that, when we were conducting our industry research and our company research, we were looking into its other operational areas like Alabama, like Mississippi, and the growth of those economies was far, far less than Georgia's, to the point where it was minimal, if not projected to take a downturn in the next couple of years. So having Georgia as, Georgia Power makes up the majority of Southern Company's revenue, and that is why we chose to put so much emphasis on the state of Georgia and Georgia Power.
Are they predicted to be cash flow positive, free cash flow after CapEx positive at any point in the future?
Actually, yeah, our projections were that they'd be cash flow positive within the next year, assuming that their plant Vogtle unit is successful. Because if it's not, I believe the deadline that the Georgia PUC set in their most recent stipulated arrangement was that it needed to be complete by the end of the first quarter, or else there's going to be, I believe it was a $30 million drop in cash flow or cash flow pressures every single month. So we expect, if Vogtle Unit 4 reaches commercial operation by 1Q this year, that they will reach cash flow positivity over their CapEx. And that's actually another reason that we believe it maintains a premium, because a lot of these other firms, you look at like Duke, for example, they maintain even consensus projections on Wall Street, negative free cash flow, which isn't anything, worrisome when you're looking at a utility and the regulation. But if you've got one that is consistently generating either less negative or getting to that positive range, that's a good sign.
Yeah. I'd also like to comment that Southern Company has been making great progress on Plant Vogtle, and they are expected and past expectations to complete it by the end of the first quarter.
Yeah, they have reached self-sustainability in their nuclear fission, which is a really good sign for it to be on track.
Yep.
One other real quick committee. What about solar? I don't hear much about solar in the presentations. Are they doing anything on that front?
They've been mainly focused on nuclear, obviously with Vogtle, and I think the highlight with going nuclear is with the high capacity factors that it has over wind and solar. And I think after Vogtle, they're going to kind of explore all the different technologies in renewable energies. I believe it's not a huge priority of them to go solar or wind, but I think they will continue to explore the different technologies and implement it further. I just think after the Vogtle completion, I believe Mr. Womack said that they're going to take a second and explore all different technologies and possibly go smaller scale nuclear. And
And to add to that, like to your question, talking about kind of what are their plans for this renewable expansion, and that's why I kind of brought it back to this slide. That Georgia IRP filing, the updated 2023, includes over 2,400 megawatts of renewable assets alone. These are battery storage. We've got the same in Alabama, all renewable capacity energy. And that includes the wind, it includes solar, it includes all different types of renewables, but that is a key focus. And you look at the Southern Power segment, right? Like that is a renewably focused segment. They're not necessarily driving the investment in these power generation assets, but they do have a focus on renewable generation. And we're definitely going to consider or continue to see that as the years progress, and like Joe mentioned, as they finish this nuclear construction.
You're projecting EPS growth over the next few years. What about return on investment capital? Do you expect that to grow?
Yeah, I mean, the idea there, or the way we look at it, is we expect it to remain consistent because even our EPS is likely to, I mean, because the regulated nature of their ROE or the return on capital, we do expect that it's going to remain in line with EPS growth, maybe that 5 or 6%. But it also depends on the actual authorized ROEs depending on the regulators. And a lot of times they're either over recovering or under recovering. So it's kind of tough to tell, you know, year by year what that's going to look like. But over a long-term basis, they're going to recover their costs. They're going to earn that authorized.
We are at time.
I